If you have ever day traded, then you have definitely had the experience of entering a trade, being handed an L by the market, and then have the market turn around and do exactly what you thought it was going to do. We've all been there. It is incredibly frustrating, but it really highlights the importance of getting solid entries for your trades. In this video, I'm going to be breaking down 3 critical steps to get the perfect entry. Then I'll show you exactly how to apply it in a real market scenario. The first step to getting the perfect entry for a trade is understanding the market bias. Honestly, when I used to hear something like that, my eyes would glaze over and I would be like, dude, just get to the trades. But it is so critically important to understand what the market is doing, because it will directly impact your success and thus the money that you can make in the market. In a nutshell, market bias is just identifying what the market is doing on a broad scale. Are we going up? Are we going down? Or are we just kind of going sideways? This is an incredibly dynamic thing. It's not like you can identify it once and be good. The market is always changing. The bias can change and you have to adapt accordingly. So looking at this chart, we can clearly see that the bias is down. No question about it. This is a really strong move, barely any pullbacks, nice 45-degree angle. And so what does that mean? Only look for shorts. So many people see something going down like this and they're like, oh man, it's got to stop here. I'm going to buy and catch this reversal. Don't be like that. Your best chance of success is following institutions. You can do that just by watching the price. If the market is selling off hard, that means the big guys are selling. Don't buy. So now that we've established the market bias is down, we want to sell. The second critical step to getting the perfect entry is waiting for price to get to a key entry point. Even though the market is going down, we know we want to short. That doesn't mean we just get to randomly short anywhere we want. Of course we can, but that will not set you up for success in the long run. You may be thinking, well, just look at the chart. If you would have sold at any point here, you'd be making money. That's true. Let's take this other chart as an example. Bias is down. We know we want to sell. Let's just sell right here. Look, we'll put our stop above the swing, give it plenty of room, and we'll look for a move down, and then watch what happens. Instantly goes to get stopped out. It's incredibly difficult to predict exactly when the market is going to bounce, but if you wait for prices to get back to a key entry point, it will increase your chances of success exponentially. So what do I mean by that? Well, a key entry point can be essentially one of 3 things. One is a trend line, like I've drawn here, connecting the highs of this move down. When prices get back here, that's when we're going to be interested in the possibility of selling. Key entry point could also be horizontal support and resistance. Zooming out, we see a clear example of that right here and right here. And the third key entry point could be something like a moving average. I personally use the 21-period exponential moving average. It's a great spot to look for trades. So now we have the first 2 keys down. Identify the market bias and wait for a key entry point. We've identified that our bias is down, we want to sell. Now price has moved back to the EMA and back to our key entry point. Is it time to sell? Now, if you followed me for a while, watched my live streams and my videos, you'll know that I often will take a trade right off the key entry point without waiting for anything else. And it's a valid strategy, but if you are missing the third critical component, it will have a much lower win rate. Take this chart for example. Our bias is down. We have a pullback right to our key entry point, the EMA and the trend line. We look to short here. This one, unfortunately, would have been a loser. And again, that's okay. Every system will have losers. As long as the total sum of your winners is bigger than the total sum of your losers, you will be profitable in the long run. But if you want to increase your chances of success and give yourself more confidence that the one you're about to take will be a winner, you need the third critical piece, and that is a repeatable pattern. In this case, we would be looking for a second entry or a 2-legged pullback. Now, There's nothing magical or fancy about this pattern in itself. It's just a representation of what is happening with prices. We want sellers to be in control. We want them to push the market down. And in order for that to happen, the buyers have to give up. And when we wait for a second entry, what we are doing is having the sellers prove themselves 2 different times to confirm that they will continue the momentum downwards. So here's the pattern: a pullback. That is the first time that buyers are trying to reverse the market. Sellers push down a little bit for the first entry, and the second leg of the pullback. That's the second time that buyers are trying to reverse the market, and then we see a bearish signal bar right at our key entry point, the 21 EMA. But we know the market bias is down, we're right at a key entry point, and we have a repeatable pattern that is affirming our read of the market. So going short 1 tick below the signal bar, looking to scalp for about 2 points, that is an instant winner. Now let's say you didn't take this trade for whatever reason. Maybe you were a bit nervous, the market just opened, this signal bar was a little bit doji. The market will give you another opportunity to enter. Simply wait for a lower high, which is like one final attempt for the buyers to get something started before it gets smacked down. And right here, you have a lower high right at the key entry point, confirming the second entry short. If you didn't get this trade, definitely enter on this one. And again, going for 2 points, that is an easy winner. So now that we got down our 3-step process, let's apply it to this chart and see what trades we could have taken. The market is moving down, and with how strong this bearish trend was, we are still not expecting the market to reverse. So instead of seeing a break, a new low, and then a reversal, which is a common pattern, with this strength, you want to look for a secondary channel. And now again, we have our bias, we have a key entry point. Let's wait for prices to get back there. It hasn't got back yet. We didn't quite touch either of those entry points. And then right here we have prices right at our key entry point, confirming our bias. It's time for step 3, wait for a repeatable pattern. Here we have that first leg of the pullback. Buyers' first attempt to reverse the market. Sellers are pushing back down. We have the second leg of that pullback, which is the second attempt for buyers to reverse the market. And if we get a bearish bar, that is going to be our second entry. And there it is, absolutely perfect. Beautiful bearish bar, 2 very clear legs up right at our key entry point. It easily goes for 2 points. That's another perfect trade. Now you wouldn't necessarily take this one because there was a news release right at this time. But for educational purposes, for being able to identify the exact moment when you would want to enter, this is textbook right here. But since we do have news, we would want to let the market die down a little bit, give it some time until the bars are not quite as volatile. Now we're back to our first step, identifying the market bias. Well, we've had 2 channels that have both had a break and a new low. This channel had a break and a new low, and the secondary channel had a break and a new low. We cannot keep drawing downtrends over and over and over again. Eventually, they're not going to work. You need to be ready for the market to start to reverse once you see a major channel have a break and a new extreme. So our market bias is still down, right? If you zoom out, you do not want to buy this, but this has changed it a little bit. Now we're going to wait for a correction to take place. Still not looking to buy. Oftentimes the pattern on this kind of day is a big move down like this, consolidation for a while, and then another big move down. So that's what we're waiting for. We're only looking for opportunities to sell. So let's let the bullish correction play out. We are now pushing below the EMA, and just as things are starting to get going, we have another push up. We can't get too eager to sell. The market bias is shifting. It is not as strong as it once was. We can even start to identify a range We're not anywhere near a key entry point. Remember that identifying the perfect entry for a trade means being patient when conditions aren't lining up, and right now they're not lining up. But we have this uptrend that has played out with a break in a new high. We're starting to move down. This could be our moment for a sell. So we'll identify our key entry point. We're going to wait for a trade to take place around there, in this case the 21 EMA, and we're looking for that repeated pattern, that second entry. There's the first entry, and we already reached a new low of this downtrend. So unfortunately, we have to pause again. We need all 3 steps to line up, put the best odds in our favor. Before a stronger trend can develop, we are pushing up pretty strongly. So is it time to buy? This looks like an uptrend. We're pulling back to the EMA, right? Let's get a good buy going. Again, zoom out. Remember where you have gone for the day. This is the kind of pattern that can easily be a bull trap that just drops off into nowhere. So we have to be ready for that. It is not time to buy yet. But before we can drop off, that we do have an uptrend that might need a new high. So we'll wait for that to happen and then look for another push down. Here's our new high. We're waiting for a push down, but instead the market just trickles off into the close. So although the market didn't offer any high probability setups in the latter half of the day, because we were ready, because we had our bias, we were looking for key entry points, and we were waiting for repeated patterns, we got 3 magnificent trades right here, here, and right here. Even trading just one contract, that would have been $600 that we could have had before most people even wake up in the morning. Then imagine if you have like 20 funded accounts with Apex, how incredible that number can be. So all it takes is patience, paying attention to the bias, the key entry point, and the repeated patterns, and you can have some incredible success in the market. Catch you guys on the next one. Take care.